Bank of America strategist Michael Hartnett has long warned that the next market shock could come not from equities or inflation, but from credit itself. His so-called crunchy credit thesis outlines a chain reaction. Credit cracks widen, the Federal Reserve responds aggressively, and investors rush into hard assets like gold. Recent market events suggest that theory is beginning to find footing. Regional banks in the U.S. have shown visible strain. Zions Bancorp, Western Alliance, and other mid-sized lenders reported rising loan delinquencies and pressure from unrealized losses on bonds. These cracks in the financial system have led banks to tighten lending, slowing credit flow and heightening concern about broader contagion. Consumer credit is under pressure as well. Subprime auto loans and credit card delinquencies are climbing, signaling that households may struggle to service debt if growth falters. Corporates are not immune. High levels of debt combined with rising refinancing costs create a potential domino effect if defaults increase. Bond markets are already reflecting this stress. High yield and investment grade spreads have widened, showing that investors perceive higher risk. Hartnett thesis anticipates that when these conditions intensify, the Fed may pivot quickly from its current tightening stance. A surge in credit stress could compel the central bank to implement aggressive rate cuts, flooding markets with liquidity in a familiar historical pattern. This potential policy response aligns perfectly with his framework. Credit cracks trigger central bank easing, which then reverberates through asset markets. The reaction is already visible. Banking stocks are under pressure, while investors are shifting towards safe havens. Gold, treasuries, and other hard assets are benefiting as risk-off flows pick up. Even global credit signals support the pattern, with certain European and Asian lenders showing signs of strain that could amplify U.S. vulnerabilities. Hartnett also links this to his gold outlook. Based on historical bull markets, he argues gold could surge towards $6,000 an ounce by next spring if credit conditions deteriorate enough to force aggressive Fed action. Bank of America official forecasts are slightly more conservative, citing $5,000 as a 2026 target, but both rely on the same catalyst, a turning credit cycle. For now, the cracks remain concentrated but growing. Rising delinquencies, regional bank stress, corporate debt pressure, and widening spreads all point to the scenario Hartnett describes. If these trends continue, the Fed may have little choice but to act, potentially validating the crunchy credit thesis and fueling further gains in hard assets. Disclaimer: this story is for informational purposes only